Welcome, everybody. This is Zacc Call. Today we have Tim Holland and Tyson Williamson with us. Tim's been on before. Tim is with Orion. Orion is one of the larger asset management firms in the country. And Tim's role is OCIO, Outsourced Chief Investment Officer. And that's the capacity that Orion in general plays for Capita. I'd like to introduce you to Tyson Williamson. He's been involved with your accounts for quite a long time now, but this is the first time we've had him on this webinar with us. Tyson oversees investment operations at Capita. He is our director of investment operations. So he spends his time doing a ton of audits, to the point where sometimes he even pesters the advisors because he has a brand new audit to check on things and make sure that all the balances are just right, that there's not too much cash, too little cash in portfolios, that individual positions haven't drifted too far. Any of the investment managers, he does due diligence on them. He pesters. Tyson's job is chief pester person. He's constantly asking for information. He's constantly holding people's feet to the fire, and he's the right man for the job. When I wanted to hire someone for this role, I cannot count how many people I interviewed, and I can't count how many layers deep I went saying, it's probably not the right role for you, but do you know someone else? And then I kept doing that, kept doing that. I finally found Tyson. He's the right guy for the job. It only took us a year and a half to go through that process. And just so you know, in general, Capita is ultra picky with whom we will onboard to the team. So if we can't find just the right person, we will suffer through working harder in order to get just the right person. In general, I think that's a good business decision because it means the right people end up with us and taking care of your wealth. So with that being said, I'm excited to have both Tyson and Tim. Ryan Dressel was on the registration. You may have seen his name there. Something came up for him. Ryan's like your deep data guy in the background. He creates a lot of analysis and helps us see correlations and creates wonderful charts to understand the economy. So we'll use a lot of his resources. The deck he's provided today is a lot of Ryan's work, but Tim is really the chief there to help deliver it and oversee it. So that's a quick summary. Today's conversation is very market focused, very economy focused. In the past, we've done some conversations around how do we actually advise you? How do we structure your portfolio? So sometimes it can be tricky if you're expecting one thing or another. So if you are thinking, hey, I'd like to know more about how do you bring the different strategies together, then reach out to us. Sometimes we do that in this call, but if you want that right now, talk to your advisor and they can walk you through that. Today will be much more about the market and the economy. We'd like to go through what's happened recently, what we like, what we don't like, what we're looking at in the future, what to be concerned about, all of those things. Tim, before we dive in, is there anything else you would add to the kind of the summary? And while you're talking, I'll stop sharing my screen, and
Sure.
I'm just going to actually rule one last thing on housekeeping before you dive into other things you may want to cover. For those attending, we have the chat functionality, and I've opened that up for everyone. Just know that way when you chat, most likely everyone sees that. That's okay. Perfectly fine with that. And then the Q&A. I have found the Q&A is a little bit better if you want us to answer your question, because it keeps them separate and I can keep track of those better. So if you have a question that pertains to something later in the session, I'll hold on to it and make sure we answer it when we're going to be on those slides. If it's a question that is not related to the session, I'll see if we can quickly answer it, or we'll hold it and let you know why we didn't, and we'll get to you personally after that. So really, it helps me ensure that I don't miss anything if the chat feed gets filled up quickly. So throw your questions in the Q&A. Feel free to throw it in the chat if that's not intuitive to you, and I'll figure the rest out. And then I think we should be good to go. So while I stop sharing here, Tim, is there anything else in terms of getting us started that you think we need to let everybody know?
So not to sort of front run some of our comments, but and we're going to follow the outline that Zacc laid out, and we think that makes sense, especially as we kick off a new year. But I think we're in this goofy spot from for lack of a technical term, from a market and an economic perspective, where and I hate to sort of root for bad news, but the markets want some bad news as it concerns the economy. And as you know, we're all long-term investors, and it's just a better way to invest. And I approach the markets and the economy from a point of optimism because history tells me that. But if you just think about the start to the year, and I know as a long-term investor, I shouldn't be putting too much weight on, the fact that it's only January 17th, when we've gotten a sort of a better than expected economic print, bond yields move up a little bit, equities wobble a little bit, and people get a little nervous because all of a sudden they start thinking that the Fed, which we're going to talk about, maybe isn't as close to cutting rates as a lot of folks on Wall Street want them to be. So, and we'll talk about that in greater detail, but we're kind of in this point in time where a bit of bad news is good news. And sometimes bad news is good news on Wall Street. Sometimes bad news is bad news. And sometimes good news is good news. And we're at this point where a little bad news would be good news around the economy. So I just want to sort of frame that out. And Ryan does send his regards. He wishes he could be here. Something came up. It was unavoidable. And you're right. He does all the heavy lifting on the content. I get to just kind of relay the materials he pulls together, but he sends his best. But I do think that's an important point as we look back on a really strong year and sort of think about where 2024 is going to go, if that makes sense. Okay.
Like it.
So
and while you're pulling up your slides,
yeah.
So I like to see if I can help interpret, because I feel like you're as we think about bad news being good news, that's because the general investor understands there's normal cyclical, nature of ups and downs of markets, right? So the reason bad news could be good news is because a long period of time without bad news becomes concerning as to how bad the bad news really will be. I mean, am I summarizing that right? It feels weird.
Can I throw out one quick example?
Yeah, go ahead, Tyson.
So one of the specific things I think of when it comes to bad news being good news is right now in this situation, the unemployment rate, right? Nobody wants to see a higher than, 2%-ish unemployment rate. But if the unemployment rate were to be super low, meaning pretty much everybody that wants a job has a job, then that signals to the Fed that they shouldn't start cutting rates yet. So as long-term investors, we want rates to come down from where they are. And if we get really positive news on the employment front, that's going to signal to the Fed, hey, we should keep rates higher for longer. So that's one of those small examples of, bad news being good news.
Yeah, and so you're right, Zacc, and you can tie yourself in knots with this stuff. It can get pretty confusing even for folks who do it every day. But to Tyson's point, the big story of the end of last year, and I know now I'm sort of front running all of our content, was the Fed's December meeting when the Fed closed out 2024 without raising rates, even though they had still one more rate hike penciled in, and then telegraphed 3 rate cuts and explicitly said, we're done. So then the whole argument became focused on, okay, well, when do they first cut? And we'll talk about this. I'm going to be repeating myself when we get to the slides, but the market started expecting rate cuts pretty soon. And if there's one thing, and we know this, the market's really like, it's cheap money and lower bond yields and lower interest rates. And so until we get there, the market's going to be a little bit on edge, worried paradoxically that the economy, to Tyson's point, even with everything the Fed has done, is still so strong that those rate cuts and that those lower interest rates and that cheaper money is further down the road than people think. Conversely, to your point, Zacc, you don't want too much bad news, because really bad news means a deep recession, and no one on Wall Street's expecting that either. I think most folks are thinking we're somewhere between a soft landing, which we'll talk about. I'm going to have nothing left to talk about from a slide perspective. I apologize.
Oh, trust me, I looked through the slides. There's a lot of explanation needed for a lot of these things.
Pictures of my kids pretty soon. Though they would kill me if I did that. That a lot of folks think we're going to get to somewhere between a soft landing, which is kind of flat, slightly positive growth that allows the Fed to cut rates, or maybe a mild recession, which I think Wall Street would be okay with. Not that recessions are good, to Tyson's point. You don't want to see people lose their jobs, but that would allow the Fed to go even quicker. So you don't want too much bad news, because that speaks to an economic downturn that I don't think anyone really is expecting, including us. but you want some bad news, because I think what would really spook the market beyond a really rough economic period for the U.S. would be a re-acceleration in economic growth and inflation. That would, I think, rattle the bond market. And we know what happened when the bond market got rattled last summer into the fall, and equity sold off and the 10-year yield went to 5%. So a little bit of bad news wouldn't be the worst thing that happened for Wall Street right about now.
Love it. Okay, let's do it. You want to start
Okay.
sharing your screen, and then I think as we work, the slides are in a great order. Let's work through that, and then folks can
Sure.
ask questions as they go. I see some coming through now, and I'll keep track of
Great.
all of that, Tim, so you can
Great.
just focus on slides.
Okay, so hopefully you all can see Capita and the market and economic outlook, the cover slide. And as we go, Zacc and Tyson, write questions as they come in or comments. Please let me know, and I'll take a pause and we can unpack stuff, as they say in Silicon Valley, or double click on that. I don't know. That's my Silicon Valley ease. I attempt at Silicon Valley ease. So let's see. So to Zacc's point, we're going to take a look back on Q4. We're only a couple weeks into the first quarter in the new year. What did markets do? And importantly, what drove those return streams, at least based on our analysis? And then also to Zacc's earlier comments, what do we like and what don't we like as we move a bit further into 2024? And again, we're kind of in this goofy spot where there's a dance between Wall Street expectations around monetary policy and interest rates, and a data set that so far has been a little bit nuanced or mixed, with some economic data stronger than expected and some weak enough that that sort of soft landing, mild recession outcome is a reasonable one to expect. So the fourth quarter closed not that long ago, 2.5 weeks ago. May seem like a long time ago. All of a sudden, for me, 2023 does seem like a long time ago. And the older you get, the quicker the calendar pages turn, but that's a different story for a different day. It was a really good fourth quarter for U.S. equities and U.S. bonds. So at least as it concerns U.S. equities, the S&P, November of 2023, on the left-hand side of the screen, was one of the best months in the history of the benchmark. The S&P was up near 10%. You can see that circled lower left. And that followed on a pretty tough September and October and really late summer. But it wasn't just stocks that did well in November. Bonds, which tend to be a bit more staid and a little less volatile, as you would expect, and maybe not as exciting or glamorous as stocks, also did really well in November. The Bloomberg U.S. Aggregate Bond Index, really consider that the S&P 500 for good old-fashioned high-quality fixed income, had its best month in decades. Really the best month ever for the aggregate, up north of 4%, which may not seem like a big move for stocks, and it's not, but for bonds, to do 4% plus in 1 month, that's essentially a year's worth of returns in 30 trading days. So November, as good as the fourth quarter was and last year was, and both those periods were, they were sort of both underpinned by an incredibly strong November for stocks and bonds. And we'll talk about all that in a little more detail. So that really good November got us a very good fourth quarter for U.S. equities, again, using the S&P 500 as the benchmark. It was up low double digits in the fourth quarter, again, after sort of moving sideways and then correcting in September and October. And you can see that plotted out on the left-hand side. Really found its footing in late October and then just shot higher in November, and those gains continued into December. And the same thing for fixed income. Again, looking at the fourth quarter for the U.S. Aggregate Bond Index on a total return basis for all of the fourth quarter. Obviously, we talked about a great November, but for all the fourth quarter up 6% and change. Again, just a fantastic rate of return for that part of one's portfolio. Some weakness again into October. And what's interesting is once bonds found their footing, so did stocks. And if we think about it, when bonds sell off in value, their yield goes up. When bonds go up in value, their yields come in. And as we've talked about, the yield on the US 10-year note hit a little bit north of 5%. It's in the low fours today. And once those yields peaked and bond prices found a floor, stocks did too. And both major indices were off to the races for the fourth quarter. And we got to finish out what was a volatile year for sure for the two major asset classes. But we got to finish out what ultimately was a great year for stocks and bonds. So on the left-hand side, the total return for the S&P 500 north of 26%, which is just a remarkable rate of return considering that the index, though it never really gives you the average return, but as Zacc and Tyson know, the S&P tends to give you about 9% per annum over a very long period of time, 9% or so. If you average out all the gains and losses over a long period of time. What's interesting is that the index never gives you 9% in any given year. It just sort of averages out that way. So that 26.3 is, a few standard deviations above 9% for sure. And we may get into this in a second. My memory is not what it once was, but if you think about 2023 and what the markets had to deal with, we had a banking crisis. If you looked at the left-hand side of the slide and you see the S&P 500 got off to a good start. We had the banking crisis in the spring. You see the market pull back. So Silicon Valley and Signature and First Republic, three major regional banks all went away. We had the credit downgrade. If you remember, U.S. credit rating was downgraded by Fitch. You had an oil price spike through the summer, and you had the awful attack by Hamas on Israel, along with everything else that was going on. And even in the face of those economic and geopolitical headwinds, the S&P was up over 26%. And then on the right-hand side, for the year, while the aggregate was up 6% plus, in the fourth quarter, it got us about 5.5% for the full year. It was a tough year for fixed income most of the way after a very tough 2022, because if there's one thing that the stock investors really don't like, that's rising interest rates. If there's one thing that bond investors really, really don't like, it's rising interest rates. So if you think about the Fed raising rates beginning in early March, not stopping until July of last year, that's a massive headwind for traditional fixed income. Because higher interest rates tend to just depress the prices of bonds that are already trading. Those bonds need to reset in price so their yields go up. So it took a little bit longer for fixed income to find its footing, but it ended up giving us about 5.5% for the year. And what's encouraging about that, as we look back, is that the aggregate was down in 2022 and 2021 for the full year because of inflation and because of the Fed's rate hiking campaign. So it avoided a third consecutive down year that had never happened in the history of the index. So we avoided that. And if history is any guide, and rates have peaked, and the Fed is closer to cutting rates than not, we should still be early in what should be a constructive environment for fixed income after a really painful 2021 and 2022 for fixed income investors in particular. So 2023, as volatile as it was, as challenging as it was, it ended up being a very good year for stocks and bonds.
Hey, Tim, a couple things real quick. First of
Please.
all, I've got a few of you have sent a few things through. We will talk inverted yield curve, slide 23, I believe it is. And so waiting on that one, we will talk rate cuts and increases and expectations on that a few slides down the road. So we'll hit that one. Kathy had mentioned a little bit about unemployment when you were talking about that. Maybe we could just acknowledge that comment and see if there's anything else to add there and then move forward. I'll ask that here in just a second. But on your the last slide that shows
Yep.
the return for the S&P 500. At the beginning of the year, I was reading an article that showed all of the analyst predictions in early 2000, it was late 2022, of what
Yeah,
they thought would happen in 23.
yeah,
And because 22 was so awful,
yeah,
there is what's called recency bias, that everyone believes that it will be awful again. And then because 23 was so wonderful, all the analyst opinions ticked up. And so in other words, everybody thought that the market would return somewhere between 4 and 8% going into 2023. And now everyone's saying, 5 to 10% coming into 2024. It's always like right in that range around the average, but ticks up or down a little bit just based
yeah,
on what happened last year. So in other words, analysts are not any more immune to recency bias than any of the rest of us. Just
yeah.
kind of throwing that out there.
Yeah, no, for sure. And I think, and at the risk of sounding cynical, some of those folks work for some very prominent firms, some pretty big platforms for sure. And in my experience, that's sort of a small group of folks, and nobody wants to get too far out over their skis. So I think you're absolutely right, Zacc. We look in the rearview mirror and we extrapolate that forward. And recently,
There's safety being in the
Well,
pack a little
that's
bit there,
exactly what I
right?
was gonna say. That
Like
nobody
a
wants
herd of
to
animals.
be. No
Okay,
one wants.
so Kathy's comment, she says it feels like there's been a lot of layoffs, at least in tech, at the end of last year and in the first weeks of January, but I think that hasn't shown in the unemployment numbers yet because of severance packages. Maybe I'm misunderstanding when that shows up. So it seems like unemployment numbers might tick up. Is that accurate, or is there anything else to add to that?
I I think Kathy's take is a reasonable one. And to go back in time, and if I got anything wrong, I'm not going to remember any of those mistakes. I'm just going to focus on some of the things I got right. And we were pretty optimistic coming into the year because 22 was so bad and sentiment was so bearish and valuation had reset into October. And so it's a really hard thing for all of us to do, but it's sort of take a step back and, try and, to your point, acknowledge the recency bias but also disconnect from it a little bit. Where I was wrong last year was I thought the economy would be weaker than it was. And it had some soft months, and maybe some quarters weren't as good as others, but the resiliency of the economy and the consumer, to me, were pretty outstanding and astounding. To Kathy's point, the labor market is a classically lagging indicator. It takes a while for those layoffs to hit, for companies to go from not just not hiring, not starting new positions, and then not filling existing open positions, but then cutting. It's a process. And so there are some data points like the JOLT survey, the job opening and labor turnover survey, that has shown the number of positions open have come down meaningfully. Now, there's still more open positions than there are unemployed folks. New jobless claims have stayed pretty low, but I would argue that there are some signs that the labor market could be softening, and that could be a bit of a canary in the coal mine. But we'll see. We'll see. But I think that's a very reasonable position to take.
The only other thing I'll add to that is if somebody's on a severance package, then they likely want to be actively looking for work at that time. They may be under some sort of garden leave clause where they can't
Yeah.
work, meaning they could not show up under the that unemployment rate as well.
Yeah, I think
Yeah.
that's Kathy's point, that
Yep.
they just haven't yet applied for it because they don't need it yet or can't. Yeah, that makes sense.
Hoping for a little bit of bad news there.
Yeah.
To
Not
the
too much,
discussion at
just
the
a little.
beginning, just a little
Yeah.
bit.
Okay,
Just a
you can
little
keep
bit.
going. Thank you, Tim.
Yeah, sure. One of the big stories last year, and one of the reasons I think a lot of people are sort of poo-pooing the move up in the S&P, was it was all driven by a handful of stocks. And the idea, right, the Magnificent Seven, those mega cap tech companies, the Apples, the Metas, the old Facebook of the world, the Alphabet, the old Google of the world, we're doing a disproportionate amount of the lifting for the S&P 500 because it's a market cap weighted index. The bigger companies move the needle more. And so some folks said, well, you can't really trust this bull market, which got going in June of last year, because it's so top heavy. And, the way I think about that is, if the market's moving up, not that we don't look under the hood, if it's being driven by a handful of companies or a sector or two, that's what it's doing. Sometimes energy stocks do well, sometimes they don't. Sometimes tech does well, sometimes it doesn't. So I try to sort of just look at what the market's giving us and then try and understand it. So on the left-hand side, the top 10 holdings in the S&P 500 did drive almost 90% of the total return for the index, and we hadn't really seen that before. And so I get it. That Magnificent Seven move was real. But on the right-hand side of the slide, we think it's really important to point out that the smallest companies, the Russell 2000, which is sort of the S&P 500 for small cap U.S. companies, is up over 25% since its October 2023 low, beating the big cap companies by a decent amount. And so small cap stocks hadn't done well. They don't do well when interest rates are going up. They tend to be more dependent on short-term sources of capital. So the cost of capital or borrowing can have a huge impact on profitability. So we find it encouraging that the market has continued to move higher and is, as they say on Wall Street, broadening out. More companies are participating in that move up. Small cap stocks are pretty attractively valued. They've lagged big cap companies for some time. So again, we think that's a healthy development that hopefully supports the idea that this bull market should be early days. And as it broadens out, its potential for longevity to do what other bull markets have historically done, which is run for a decent period of time, all that increases. So we're just plotting out that Russell 2000 performance on the right-hand side of the slide. And back to October 7th and the attack by Hamas on Israel. If you look to the bottom of the slide, you'll see October 9th. If memory serves, October 7th was a Saturday when Hamas launched its horrific attack. So the markets weren't open here in the US. They did open that Monday. They actually closed up a little bit on the day, and they were up a month later. And while we're not 6 months on from Hamas's attack, the S&P is still higher. And so if you sort of work up from that terrible event, you see that the markets tend to sometimes stumble when hit with a major geopolitical event, but then usually absorb that geopolitical event, come back to earnings and interest rates and monetary policy, not to be hard-hearted, but all the things that drive markets over time. And markets do a pretty good job of sort of absorbing those events and then quite more often not looking past them. So as we sit here today, the S&P is up nicely from October 7th. And interestingly enough, the price of oil, even though that event took place and continues to take place in the Middle East, is meaningfully lower than where it was. So not much of an economic spillover effect in terms of the price of oil, even though the events have been taking place in the Middle East. Okay, so that was a look back on the fourth quarter. What risk assets, at least the bigger asset classes, the ones that we probably and rightly so pay the most attention to, U.S. stocks and U.S. bonds did. So let's talk about what drove those return streams. And as we go, Zacc, if there are any other questions, please let us know. And obviously, Tyson, please continue to weigh in. We talked about recency bias. It's a phenomenon for sure, how we as investors, as people, as human beings, extrapolate recent events and sort of take those events and sort of project them forward. And tied to recency bias, excuse me, we think is sentiment, right? And sentiment is a classic contrarian indicator in our business. So essentially meaning if everyone's pretty optimistic about the markets, and coming into this year, people were pretty optimistic for sure after that great fourth quarter, and not surprisingly, markets have stumbled a little bit here. But history tells you when everyone's really optimistic, typically markets then struggle a little bit in the short term. Doesn't have to be terrible, but they tend to they don't find their footing. And at the same time, when folks are really pessimistic, in the near term, markets tend to do well. And so the way I like to think about that quote is how Warren Buffett thinks about that quote, or one of his, or that dynamic, or one of his more famous quotes is, you should try and be greedy when others are fearful, and fearful when others are greedy, which is hard to do because, again, we're wired in a certain way. So what you're looking at on the screen is a survey from the American Association of Individual Investors, AAII. It's a sentiment survey. They've been conducting it for decades. And the blue line is the percentage of respondents that are pretty optimistic. And the red line are the percentage of respondents that are a bit more pessimistic about the market. And if you remember, the market had that really nice rally into July. And what do you see? You see a whole lot of people optimistic and not so many people pessimistic. And what happens? And the market sold off into the fall. We had a rough August, September, and most of October. And what's interesting is that the number of folks that were optimistic or bullish fell dramatically. And the folks that were pessimistic or bearish rose meaningfully. So those red lines and those blue lines crossed each other again. And so that resetting of sentiment after a tough August, September, and most of October really, again, sort of set the stage for that strong rally, particularly in November and into year end. So everyone went from being probably too optimistic in the summer to too pessimistic in the fall, and that laid the groundwork. And we pay a lot of attention to sentiment because we do think it's a very powerful contrarian indicator, at least on a short-term basis. And it's a good intellectual exercise for all of us as investors to take a step back and say, okay, everyone's really optimistic in the short term. Am I missing something? Am I a little too out over those proverbial skis? Or if everyone's really bearish, the world may seem like a scary place, but gosh, can I sort of check my emotions and kind of lean into risk a little bit because equities are so, or fixed income bonds are so attractively valued. So it's a great intellectual and emotional exercise.
So, Tim, I want to share with our clients a little bit about along these same lines. Within the advisor team, of course, we're talking to each other a lot about client questions and markets and what's going on. And we keep a fairly anecdotal record of how many client questions we're getting about a particular topic. And usually a lot of us will even keep some investment cash on the sideline, or just some ability to borrow and invest more. And I specifically will wait until people start to get really, really concerned and counting, until I hear from my advisor team, which there's 15 of us now. If I'm hearing every single day that some clients are extremely stressed about it, that tells me it's time to buy some risk assets. So I'm just trying to give you guys, and it's worked. It's surprising how well it works. So I'm just trying to give you all who are more investment focused, those who join this meeting are more usually more knowledgeable, usually more comfortable, usually higher risk tolerance than the average person out there. But the reality is it is so important to think with that contrarian view. And that is why Orion is thinking, well, how comfortable is everybody? Is everybody comfortable? We're stressed about that. Or how stressed is everybody else out there? You guys are freaking out? Wonderful. I think it's time for us to invest. And it's really, really weird, but you have to think that through. And to Tim's point, check your emotions where possible.
Yeah, no, that's very well said, for sure. So pullbacks aren't fun, but they do reset sentiment, to Zacc's point. And if you can step back and observe that typically creates opportunity. The other thing that a market sell-off does is it tends to make valuation more attractive. So again, on the far hand side of the graph on the screen, looking at the PE on the S&P 500 on a forward basis, it got below 18. Now that's not screaming cheap. If you go back to the bottom in late 2022, when the S&P traded down to about 3,600, and we still think that was the bottom for this cycle. Knock on wood, we are in a new secular bull market. It traded down to 14 times earnings. So sub 18 isn't as attractive, but considering that going into the fall of last year, the Fed had already stopped raising rates, even if they didn't sort of telegraph that they were done. That didn't come till December, but they hadn't raised since July. The reset in equity prices made valuation more attractive and sentiment quite bearish. And so all those things together, we think help set the stage for that very strong November and December. Excuse me. And back to fixed income. And fixed income and stocks both finding a floor at the same time. If you look on the screen, you'll see the plotting out of the U.S. 10-year Treasury yield. And if you go all the way back to the 2010s, 18 years ago before the financial crisis, the yield on the U.S. 10-year note was about 5%. We went through the financial crisis, the Great Recession, the Fed cut rates meaningfully. And whenever you see those vertically shaded bars, those are periods of economic contraction or recession. So obviously you have a pretty drawn out recession 15 years ago because of the housing bubble bursting and real estate and all of that. On the right-hand side, you really have that policy-induced recession where we shut down the economy because of the pandemic. So it was short, but very severe. And so coming through the Great Recession and the Fed cutting rates, we entered this period of very low bond yields, really going through the 2010s. Then the pandemic hit. The Fed took rates to zero. And at one point, the yield on the U.S. 10-year note hit 50 basis points. And that's that blue line plotting out just on the other side of the pandemic-driven recession. And then yields, as the economy started to reopen and there was some supply chain pressure and things like that, and all that money that the government pushed out into the real economy because the economy was shut down, all that came together to create that inflationary pressure that the Fed first thought was transitory and then decided it wasn't. And yields moved meaningfully higher in fits and starts till eventually the yield on the U.S. 10-year note broke 5%. And that's tough for a couple reasons, because I'd argue the U.S. 10-year note is the most important piece of financial paper in the world. And the yield on the U.S. 10-year note will help determine yields on mortgages and credit cards and interest rates on mortgages and credit cards and the like. And so again, the market likes cheaper money, lower interest rates, and unfortunately, as yields moved higher, that did a couple things. As yields move up, bond prices move down, and also short-term instruments became much more attractive relative to stocks and bonds, money market funds, and the like. So a lot of money came out of the market. And it really wasn't until the yield on the U.S. 10-year note peaked at 5.02%, and hopefully that was the peak for this cycle, that once bonds sort of found a floor, bond prices, stocks did too. The yield on the U.S. 10-year note went sub 4%. It's been bouncing a little bit above 4% over the last couple of days, but it was really that peaking in bond yields being a very important catalyst for that move higher in the year.
You consider the 10-year Treasury to be the most important fixed income, let's call it benchmark or just, benchmark to be watching, because it's used as, they use it to say, okay, we're going to set mortgages at this plus a little bit or this below. Yeah. And that's it. That's the reason, right? It's used in so many other financial instruments. Is there any other reason this is so important?
And this ties back to that, but it's also arguably, the most riskless asset in the world, right? You could buy a U.S. 10-year note. Now, if inflation's running higher and you're only earning 5% or 4%, you may not be keeping up with inflation, but it's really considered the most important yield or interest rate in the world, because to your point, Zacc, other interest rates will be set off of it, but it's really considered the world's risk-free rate. Assuming the U.S. government isn't going out of business, even with all of our problems in D.C., this is something that you can buy from the world's most important country, the world's largest economy, the world's home to the world's most powerful military, and you're going to get your money back. Now, in a period of screaming inflation, it may not be the best investment, but it really is the world's risk-free rate, and it's the rate off of which so many other interest rates are set. So I know that's kind of saying the same thing twice, but that's how a lot of folks think about it, I think.
I think a lot of people look at it as an alternative too. So for example, they say, okay, if I have 3 choices of investment, they oftentimes use the 10-year Treasury as the alternative to say, I could invest at 5% in the 10-year Treasury, So if
Yep.
I'm only getting 5% cash flow on this bond over here and
Yep.
it has risk, why would I do that if I could just do the 10-year treasury at 5? Or I could invest in these stocks and hope to get 12 or
Yeah.
11 or 10 or 9 or whatever it may be, your goal on that in particular investment. You can calculate the risk premium. I'm expecting to get 12, that's 7% over 5. So how much is the risk of it? If it's insanely risky and I'm only getting 7 more, probably not a great idea. But if it's relatively diversified and conservative in the stock approach and I'm getting an extra 7, that's a good trade. That's a good investment. So people use it as an alternative comparison to decide how much risk is worth it taking.
Yep, for sure.
Two
Go ahead, Tyson.
quick tangential, but I think important concepts. One is more of a how we think about portfolios, how we think about your portfolios, right? When Tim mentioned that inflation risk when it comes to fixed income. So one thing to keep in mind is the longer time horizon you have for your dollars, the more inflation risk plays a part, which means the more risk assets that we're thinking of putting into more client portfolios, if that makes sense. Typically, risk assets keep up with inflation better than fixed income. The other thought I had, I know we're looking at 10-year rates right now, but you mentioned money markets, Tim. One thing that I'm a little bit excited for this year is, well, we've seen a run up in, inflows in the money market, short-term insurance, because people are getting paid 5% for holding cash, right? And, we're not at all-time highs last I checked, but we're close to $6 trillion in money market funds right now.
Yeah.
So when the Fed starts cutting rates, those short-term dollars, obviously people are going to have some cash in portfolios, but not to the extent they have now. And those dollars need somewhere to go. So I'm excited for some sort of, demand push in risk assets or even in fixed income to put, long-term investors ahead of investors or institutions who might have gotten scared and pulled money out into cash. So that's something I'm excited for looking at 2024.
Yeah, no, that's a great point. The proverbial dry powder at 6 trillion, what could come into the market, to your point, Tyson's a massive amount of capital. And what history shows is once you've gotten to the end of a rate hiking cycle and those short-term cash-like instruments, money market funds, those yields peak, typically on a go-forward basis, you're much better off in sort of longer dated fixed income assets and equities, which are really, sort of the longest dated investment you can buy, because you really are making a bet on future earnings, even beyond what a typical long dated bond gives you. And so once you hit that peak in the rate hiking cycle, those money market funds, those short-term instruments tend to often badly lag what good old-fashioned stocks and bonds can give you. So to Tyson's point, a lot of money in those money market funds and a lot of reasons that money could rotate into stocks and bonds, which would just be a bit more fuel for those rallies. So yeah, that's definitely that's a great point for sure.
So I have a couple of questions that I'd love to ask, but you have 3 slides after this, and there's a break right there. And the 3 slides actually help with the questions. Let's hit those 3 and then make sure that we do them fairly quickly so we can reserve good time for these questions.
Yep. So yields peaked, knock on wood, at 5%. Earnings kicked in, and I'll, for the sake of time, I'll keep my comment to the left-hand side of the slide. S&P 500 earnings grew year over year for Q3 of last year for the first time in 3 quarters. We were in a 3 consecutive quarter earnings recession where earnings were down year on year. S&P 500 companies in total were still meaningfully profitable, but earnings contracted. So earnings grew year over year for the first time at the end of in Q3. We got those results right in November in particular, and right now we're early in Q4 earnings season, and it's been a mixed bag so far. But most folks expect, call it 4 to 5% earnings growth. So there are 2 things Wall Street likes: cheap money. We've already talked about that. Lower interest rates and growing earnings, and that helped. Inflation continues to be the big story in fits and starts. The producer price index and the consumer price index, and those are the lines plotted on the left-hand side of the screen, have continued to come in. The CPI last Friday for December, I believe, came in a little bit hotter than expected, but the producer price index was cooler than expected. So inflation continuing to come in allowed the Fed to credibly stop raising rates after July, and then credibly move to a posture of, we are explicitly done. We're going to communicate that message to Wall Street. They did that at the December meeting, and then pivot to rate cuts this year. And on the right-hand side is the PCE, Personal Consumption Expenditures Price Index. That's the Fed's preferred inflation gauge. That's the index they look at to kind of get to that 2% plus or minus inflation target they have long term. We'll get the December reading for the PCE January 26th. Right now, on a 6-month basis, that number's at about 2%. So again, the inflation fight, it seems to be, knock on wood, is largely won. And as we talked about earlier, a shock to the upside would prove quite unsettling for the street.
Hey, keep in mind, folks, real quick, keep in mind, when we say inflation has come down, well, we're not saying things are getting cheaper for you. We're saying that things are getting more expensive at a slower rate than they were before. There's a key difference there. I think a lot of times people hear the news like, inflation's coming down, great, I'm going to go to the grocery store, and it's going to actually be cheaper for me. It's not going to be cheaper. It's just not going to go as expensive as quickly for you.
So,
go ahead, Tyson.
Oh, I was just going to say, to put a little bit of numbers behind that, while, inflation was looking pretty good for December, right? Food inflation rose 2.7%. Food away from home rose 5.2%. When you look at subsectors of, grocery stores, egg prices increased almost 9% in December. So inflation as a whole is coming down, but there are certain pockets where inflation might stay a little higher or might dip, depending.
Yeah, for sure. The semantics matter, right? If you're the Biden administration, you're focusing on the year-over-year change in inflation, to Zac's point and Tyson's point. Prices are going up, but they're going up at 2 to 3%, not 8 or 9%. If you're running against the Biden administration, you probably remind Americans that prices, broadly speaking, are 20% higher than they were pre-pandemic. And that's why I think, not to get in the politics of it all, the administration's rating on the economy, those numbers are so low because people remember pre-pandemic pricing. It's not year-on-year changes. It's the absolute stepping up in those prices that's caused meaningful hardship for millions of Americans. And that's, I just think, the reality of it, of the situation. On the left-hand side is what the Fed did beginning in March. So we're coming up on the 2-year anniversary of when they finally started hiking rates, and the Fed funds rate on the right-hand side from 0 to 5.5%. That's why I think we're going to get some sort of economic slowdown, because I just don't know how you can take the cost of capital from 0 to 5.5% and at some point not meaningfully impact hiring and investment. But I could be wrong. I was wrong last year, but I still think that's going to hit with a lag effect. This rather busy scatter graph is just the Fed's dot plot, the summary of economic projection. They update this at every other meeting during the course of a calendar year. And the big news coming out of the December 12th, December 13th meeting was that the Fed no longer was projecting one more rate hike, and importantly, was now projecting 3 rate cuts in the new year. And that mid-December meeting really helped light a fire under risk assets into year end. So I'll stop there, Zacc. Hopefully, I don't know if that spoke to some of the questions.
Yeah, that's great. Let's dive into a couple. Okay, so Barron's article today suggests investors backing off more stocks due to high prices, large investors shorting on stocks against continued growth, suggesting not the time to gorge on stocks. Does the group see this Barron's perspective as a need to consider backing away from stocks in the near term, or this quarter specifically?
Tyson, you want to go, and then I'll give my 2 cents?
Yeah, my 2 cents are, part of that is, contrarian views, right? When you look at various articles, people get more clicks on bad news. So you always got to keep that in mind when you're reading articles or watching the news. But I think that's a fair judgment call, right? I personally am not seeing a lot that convinces me to back off of risky assets right now, but it could happen. I'd be interested, Tim, to hear your opinion as well.
Nor
Yeah.
nor does it seem like we hear that many of our institutional investors.
No.
Like we're not getting trade signals from institutional investors saying it's time to back off on equities in these proportions and things like Saratoga, one of our managers, they're not doing that necessarily right now. I mean, they always have a little bit extra cash, but in other words, it's probably true that there are some large investors out there who take very high tactical bets. But on average, I'd be surprised to see that the average professional investors out there are actually taking that many chips off the table.
Yeah.
What were you going to say, Tim?
Now, my 2 cents would be, I think where you two sort of have landed on this as well. We had a rip-roaring move up into year-end. Sentiment flipped to pretty bullish in the short term. I personally would not be surprised to see a weak start to the year. People have gotten a little giddy as we close out 2023. So I'm expecting some volatility, some red or down days for sure. But I think, again, the Fed is done. I think we're still early in this bull market. I think we're still in the seasonally strong stretch of the calendar. So not to sort of punt on the answer, I would be okay in expecting some down days, and I would put that in perspective more easily than I might at other points in the cycle, if that makes sense. Again, big rally into year end, some weakness expected, lots of bulls out there short term. But if history's any guide, especially with the Fed moving to rate cuts, I still like being at least equal weight risk, whatever my equal weight would be as an investor. Everyone's got a different profile, if not slightly overweight risk, considering where we are in the cycle.
Okay, so that, Mark, I think that hits a lot. We've hit the Fed cut increases, interest rate changes, sorry. So I'm going to move on from that one. And then Sean and Mary got that one. So there is one question, and maybe you can give a one-word answer. Let's see how quickly, because I really want to hit the inverted yield question. But are market reaction profiles changing with automation?
So I would say, if you want to, I'm already past the one-word answer. If that sort of refers to algorithmic trading and computer-driven trading, I would say yes in the very short term. That you can have a piling in effect around certain securities or asset classes in a very short period of time, as all those smart hedge fund folks who hired all those smart computer programmers see the same thing, but that those trades tend to be very short-lived and then wash themselves out very quickly. So that was not a short answer, sorry.
No, but that's good. So then you're saying that there is still benefit in understanding the long-term macroeconomic trends coupled with fundamental analysis of businesses. And that short-term trading will wash itself out, and then the true fundamentals will actually help people profit on good investments. Is that what you're saying?
I would say, yeah, that's much better said than I said. So thank you.
I just want to, okay, that's great. Okay,
the only thing I'd say real quick on that is the markets have always been, and I believe will always continue to be, a healthy mix between the data and the people, right? Sentiment, like we've talked about a lot in this call, plays a big impact. So, algorithmic trading, AI, is going to affect a lot on data and quick execution. But once that gets fully integrated, it will be back to just the next big thing.
Okay, so let's dive to the last. I think this might be our last question, and obviously, if we have time, we can stick around. But the question has to do with the inverted yield curve. Now, it was like a telltale sign: inverted yield curve equals recession, and yet we have experienced it multiple times, and we're all just waiting for the recession door to open and for us to have to walk through it. And we can't tell, like, and obviously it's hard because a recession is no longer perfectly defined by 2 quarters of negative GDP growth. It's defined by a whole bunch of metrics, and somebody gets to decide whether we had it, and it could be in the past. I'm telling everybody this so you have context. So the question is, does an inverted yield curve always precede a recession, or are there cases where the economy has escaped a recession after an inverted yield curve? And I know you have slides on this too. Go ahead.
Yeah, let me, so this is, again, I'll skip ahead a little bit. So the Fed's expecting projecting 3 rate cuts. Markets are pricing in 6 beginning in March. So that's why sort of the volatility around better than expected economic data. Markets would like to see some weakness because that means the Fed can move sooner than later. But I think I've got the inflation is going to continue to be the big story. The economy so far, at least based on the Atlanta Fed's GDP nowcast, is projecting 2.7% growth for Q4. We'll get the Q4 number soon. Labor market, to Tyson's point, sub 4% unemployment rate. The yield curve. Okay, so this only goes back about 5 years or so. And what it's looking at is the spread between the yield and the US 10-year note and the 2-year note. And at the risk of putting everyone to sleep with a few minutes left on the webinar, typically what the yield curve is a plotting of the yields on offer across the sort of US government fixed income spectrum. And that's really bills, notes, and bonds. Bonds being the longest dated paper, like a 30-year bond, notes being in the middle, like a 10-year note, and bills being, say, a 3-month bill. And what you would expect is that yields on short-term instruments are lower than yields on longer-term instruments because, you know, the further you lend money out, the more inflation risk you run, prepayment risk. Maybe the government goes away, you don't get your money back in 30 years, the US government's no longer here, so on and so forth. But every once in a while, the yield curve inverts, to Zacc's point. And whenever the yield curve is inverted, not whenever, not always, but typically a recession follows. We kind of had one false signal in the mid-90s, but the yield curve was inverted for a very short period of time. Right now, what we're plotting out is an inverted yield curve looking at the 2-year and the 10-year. The yield curve has been inverted for about 14 months. So to Zacc's point, you know, it's one of the reasons why I think we're going to get a recession. Hasn't shown up yet. There were 2 other periods where the yield curve was inverted 18 months before the recession hit. So we have had long periods of inversion before the recession showed up. Again, I'm not rooting for one. They do terrible economic, emotional, physical damage to the folks that are usually least prepared to deal with them. But just because we haven't hit a recession yet, even though we've had such an inverted yield curve for so long, doesn't mean we won't get one. And whenever the yield curve has been this inverted, meaning the spread between those yields is this pronounced, you've always gotten a recession. So I still think we're going to get some sort of economic weakness. The yield curve inverting doesn't cause the recession. So it's not a perfect crystal ball, but most folks seem to think that it reflects the bond market pricing in a recession, and it reflects a particular dynamic in the banking system that could lead, set the groundwork for a recession, meaning, and this may be a little too convoluted, if banks borrow short-term, they pay me 0.5% to put my money in a checking account, and then they loan that money out at 5% on a 30-year fixed mortgage, that's how they make their money. Well, when that flips and they have to pay me more to borrow from me than they can make loaning that money out, there's no incentive to create capital. So that's how I like to think about the yield curve, that inversion just kind of gums up the works in terms of credit creation and growth and fuel for the economy. So long answer, very inverted yield curve. We've been inverted this long without a recession, and 2 meaningful recessions followed periods of 18-month inversion, and we're not there yet. So that's how I would answer that. I hope that helps.
Perfect. No, that's great. So we're at time. Can you give us, I know you have a couple slides with parting thoughts, but like, what's the most important thing for people to walk away with today?
Couple things.
And by the way, these slides are available, so we'll send them out for everybody, but keep going, Tim.
Yeah, sure. Sorry. So whenever we've gotten past Fed rate hiking cycle, typically the markets have been up 6 and 12 months on. So the Fed got done in July of last year. So history is on our side there. To Tyson's point, about $6 trillion in money market funds today, that could get pulled off the sidelines. And then finally, those blue periods are trough to peak periods in prior bull markets. I know the markets have done well. Some weakness near term isn't to be unexpected. But if history is any guide, bull markets do tend to run for a very long period of time.
Perfect. Love it. Well, thank you for everyone joining. Tim, as always, thank you for your expertise. Thank you for the time. If you guys knew how much time Ryan and Tim putting into just making sure this information is exactly what Capita wants, You love them. We love them. We appreciate your work on this. And then, of course, clients, I have actually taken screenshots of questions that we didn't get to. So we'll see if we can somehow get you some answers anyway. But we love that you joined. Thank you. You folks that joined this, we know your names. You guys are stalwart and you're very involved and know what's going on. You're smart. Appreciate it.
Thank you all.
Thank you.